Rossari Biotech Limited's earnings conference call. As a reminder, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us on Rossari Biotech Limited's Q2 and H1 FY24 earnings conference call. We have with us Mr. Edward Menezes, Promoter and Executive Chairman, Mr. Sunil Chari, Promoter and Managing Director, and Mr. Ketan Sablok, Group Chief Financial Officer of the company. We would begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Edward Menezes to make his opening remarks.
Good evening, everyone, and thank you for joining us FY24 earnings call. I hope all of you had the opportunity to go through our results presentation that provides details of our operational and financial performance for the second quarter ended 30th September 2023. This has been a record quarter for us, and we are pleased to report the best ever performance both in terms of revenues and profits. Revenues improved by 14% year-on-year to rupees 483 crores in Q2 FY24, primarily fueled by our core HPPC segment growing by 21% and our textile division that was up 5% on a year-on-year basis. In our AHN division, we encountered some seasonal softness leading to a subdued performance. On the profit front, PAT surged 38% year-on-year, reaching rupees 33 crores in Q2 FY24, driven by the significant improvement in revenues. Such performance is especially noteworthy considering the current tough operating environment in the chemical industry. In the face of the challenges that marked the previous year, we are happy to see momentum in our core HPPC offering during the quarter. This positive trajectory is a testament to the dedicated efforts of our team on the ground. Coming to our growth plans and commitment to future readiness, we are excited to announce the expansion of our facility at Dahej by 20,000 metric tons per annum. This strategic move would enable us to enter new domains within the HPPC segment as well as pave the way for producing essential ingredients for our subsidiary companies. In addition, to cater growing demand in sectors including agrochemicals, home and personal care, oil and gas, and pharma, we are augmenting the ethoxylation capacity at Unit of Chemicals. With our existing 36,000 metric ton per annum ethoxylation capacity already operating at optimal levels, the planned expansion of an additional 30,000 metric ton per annum aims to meet future demand. Looking ahead, our focus remains on diversifying our customer base and targeting higher margin segments. We are confident that our strategic initiatives, along with our commitment to R&D, position us well for sustained operational and financial performance in the future. With this, I would like to conclude my address, and I now hand it over to Mr. Sunil for his comments.
Good evening and a warm welcome to everyone. I would like to begin by underscoring Rossari Biotech's robust growth trajectory over the past 3 years, which has been driven by a blend of both organic and inorganic growth initiatives. To put this growth into perspective, our revenues for the year FY20 for the first half was 350 crores. Impressively, we already exceeded this milestone in our first quarter, and our first half of the current year with revenues reaching 900 So from 350 crores in the first half year to 900, it is nearly 3 times growth in the last 3 years. Regarding profitability, the EBITDA and PAT for FY20 stood at 105 and 65 crores respectively. Notably, within the first half of FY24 alone, we have attained an EBITDA of 121 crores and a PAT of 62 crores. Overall, such performance not only highlights the company's commitment to driving growth, but also reflects our strategic focus on enhancing value for all stakeholders. While our recent strategic endeavors and investments have moderated our return ratios over the last 3 years, it is important to note that our balance sheet remains extremely strong. These investments were made very prudently with a clear focus on driving future growth. As these initiatives begin to yield tangible results, we remain confident that a significant uptick in our return metrics will materialize in the future. On the organizational front, we have further strengthened our leadership team, reflecting our commitment to nurturing and elevating talent from within our rich in-house pool. Their expertise will be instrumental in spearheading our strategic initiatives in the future. Such additions to our leadership team over the years reflect our ongoing endeavors to build a professional team fully equipped to guide the company as we envision managing a substantially larger organization in the coming years. Looking ahead, our HPPC segment is well positioned to deliver healthy growth, especially with the underlying industries expected to pick up in the second half. While the textile sector outlook remains muted for now, we remain hopeful and committed to identifying opportunities within this space. Our AHN division has been slow because of muted demand. However, we are hopeful of a better trajectory for the rest of the year. In conclusion, we remain focused on delivering long-term value to all our stakeholders and remain confident in our ability to take advantage of existing and emerging opportunities. Thank you again for being part of our growth journey. On that note, I would now request Ketanji to share his perspectives.
Thank you, Charissa, and good afternoon, everyone. Let me provide you with a brief overview of the financial performance for the quarter and half year ended September 30th. So on a consolidated basis, our company achieved a record revenue performance of rupees 483.5 crore during the quarter, signifying a 14% YOY growth. This has been a marked improvement compared to our performance in the recent quarters, despite the ongoing challenges in the external environment. The HPPC division delivered a robust growth of 22% YOY for the quarter, again led by strong contributions from agro, phenoxy, institutional cleaning, paints and home and personal care. Textile Specialty Chemical division the performance improved by about 5% YOY, while AHN experienced a dip in performance mainly attributed to the seasonal variations in demand. We are pleased to announce our highest ever EBITDA and PAT performance this quarter. Our EBITDA improved by 13% YOY to 63.6 crore, up from 56.5 crore in Q2FY23. Likewise, our PAT for the quarter surged by 38% to reach 32.9 crore compared to 23.9 crore in the corresponding period last year. Even amidst a fluctuating business environment, the company was successful in maintaining its profit margins on a YOY basis. I would also like to emphasize that Rossari's balance sheet remains remarkably strong. As of September 23, our net debt to equity ratio stood at a low of 0.05. The working capital was higher as of this quarter end at 98 days versus 79 days in March, but this was in line with the growing size of the business. We had a strong agro offtake in H1 and the payment cycle is generally long with these customers. Also, the major institutional sales that we did in Q2 also had a long payment cycle. However, all the receivables are good and all of them have a long relationship with us. There's been a slight increase in the inventory days also, but this is mainly as we purchase certain key raw materials for stock in September as part of our production planning for Q3. Coming on the expansion plans mentioned by Edwardji, we have allocated a capex of 50 crores for Dahej expansion, while the ethoxylation capacity at Dahej facility of Unitop has an outlay of 128 crores. These investments and projects will be executed in a phased manner, and we anticipate their commissioning by Q3 of FY25. Our financing strategy encompasses a balanced blend of the company's internal accruals and external borrowings. Additionally, our ongoing focus on enhancing capacity utilization, adding new products in our chemistry basket, further strengthening our R&D and increasing our customer and geographical presence will go a long way in further strengthening our business model for future profitability. To conclude, as the macroeconomic environment and the RM situation stabilizes, we remain confident in our capability to deliver healthy performance across all our business segments going forward. Thank you for your continued support and confidence in Rossari Biotech. On that note, I come to an end and open the floor for Q&A. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon, sir. Thanks for taking my question. I got a few of them. First, on the volume growth in the HPPC and the standalone, it appears to be super strong considering that there is a significant fall in the raw material prices and the revenues on the standalone basis appears to have gone up by 81%. Can you help us understand what has driven this strong growth, both YOY and sequentially there is again a 65% growth? What category within the HPPC is this be growing in the standalone basis, which is driven such a strong growth, and how sustainable is this number? That's my first question. And a related question on the subsidiaries of the HPPCs, which is your standalone minus consolidated, that appears to be softer quarter on quarter, while Q2 is seasonally very strong because of the agrochemical cycle now. Just wanted to understand curiously why Unitop revenue appears to be sequentially softer despite a seasonally very high quarter.
Sanjay, namaste. I'm Sunil here. You asked us for the strong growth. The strong growth has come from across different segments within the HPPC. So home personal care, performance chemicals including coatings, paint, water treatment, paper, ceramics. We have had sales in all this. Whatever was needed in the past has come to now. So we have also home care. Also, we have some good new customers for anti-duty position agents. So all in all, whatever we have seen in the past has come up very well. Our capacity utilization at the H now is nearly 77 to 80%. Our capacity utilization in Unitop and Tristar is nearly 100% in the last quarter. So we have had a very nice quarter in terms of demand, and that is why we have also taken up expansion at both Unitop and also at the Rossari Biotech factory. Regarding the second question,
Sanjay, what was your second question?
On the subsidiary performance, which is standalone minus consolidated, while for Unitop this is a seasonally a strong quarter, right? Q2.
Yes.
While quarter on quarter the revenue appears to be flattish on standalone minus consolidated number.
So, as we discussed earlier also, we should start looking at these numbers on a consolidated basis. In standalone, it's not just simply subtracting the subsidiary minus that, because there are a lot of intercompany sales that are happening. So a lot of new businesses. Some of them we are doing it through Rossari, some of them we are doing it through Unitop or TriStar, depending on the customer requirements and also depending on how we would like to position those sales. So ideally, it would be better to look at these numbers at a consolidated level.
But I thought that is more Unitop selling to Rossari than Rossari selling to Unitop, right?
There are intercompany sales between the two, because there are certain customers of Unitop who also take some products in textiles and also in TriStar, some in the home and personal care. So some of them is done through Rossari and then transferred through them. So that's how we are looking at it.
Okay. Fair enough. But if you just want to talk on the Unitop results, X of this intercompany, how has been the Unitop's growth on a YOY basis?
Yeah, so Unitop has done well. As Mr. Chari said, the capacities have not peaked in the first half. YOY, there's almost a growth of about 25% in Unitop. It's about 18-20% in TriStar. So both of them have done significantly well.
Got it. That's fair enough. Second, on the margin, while the revenue growth we are positively surprised, but on the margin front, our assumption was that the raw material has fallen. So optically margins otherwise would have improved, plus a very strong operating leverage now that the utilization have gone from 50% to 70-75%, and margins are still at 13.1%, which indicates a much lower return ratio on an overall company now that we are nearing peak and already doing the second level of investment to drive the growth. How should we see this entire margin phenomena for us?
So if you see this quarter, Sanjesh, our key has been to up our utilization levels across all our plants. That's what we had talked about in the last quarter also.
Correct.
So we've seen that coming up very positively at Unitop Dahej and the TriStar plant, and also at the Rossari plant at Dahej. Now, while we've done this, raw material prices have been generally stable over the last 2 quarters. Maybe some of the raw materials would have also seen a slight dip, but prices have seen some corrections on our front. And for us, I think this quarter we took certain calls in terms of increasing our overall offtake and increasing our volume, which has also impacted slightly on the pricing side. That's one. Second, if you see this quarter, we've seen a significant drop in our AHN business. AHN has been a slight dampener for us. The main reason was that there was a seasonal fluctuation and the demand was not there. And there are certain business which we used to do, which was the feed business, which we have taken a call to overall reduce that business because we were facing certain issues with the customers in terms of payments and payment cycles. So we have significantly downgraded that part of the business. So that has also impacted the AHN revenue. Now AHN, as you know, is a high gross margin business for us, and that business dropping by 30-35% on a YOY basis has also impacted the overall margins. Also in this quarter, if you see, we've had a little bit of jump in our other expenses. Of course, part of if you see it as a percentage of sales, it's almost at the same level, but on an absolute basis, we've had some maintenance expenses which we incurred at Unitop as well as at our Rossari plant. And with the increased sales volume, there were increase in utility consumption, the freight, and also all of them impacted the other expenses also going up. And some selling and distribution expenses also we incurred at a higher level in this quarter in terms of some of the travels and exhibitions we incurred in this quarter. So overall, if you see, that's why the EBITDA are at in this quarter about 13.1%. But if you see at a half-yearly level, it's at about 13.5%. I think given the current market situation, the things happening globally, we would be happy to push our volumes, grow our revenues, and of course keep improving our capacity utilization. Margin is something which once we get the top line going, I think margins we can always come back to. But I think we should expect similar kind of margins at least till the end of this year.
Fair enough. But again, just to follow Ketanji on that, this is contrary to what Edward sir mentioned in his opening remark about growing more higher margin business, while the margin trajectory is slightly on a downwards movement. So when should we start again seeing margins improving, say, in FY25 and FY26?
Sanjay Chari here. What we have told in the past earnings call also, and past answers to your questions in the last 3 earnings call, we are now not focusing on margins as percentage at all. I think all of us should be happy that we at 63 crores of EBITDA, we have a highest EBITDA ever. So I think we would only focus on EBITDA as amount rather than as EBITDA as a percentage. We will not be looking at EBITDA as a percentage in the future.
No, that I completely, fairness to that, I agree to that, sir. But what is happening is that our ROC is now dipping below 20%, right? Our working capital has gone up. Margin, if we don't like, has an implication in ROC, which is declining. And we have a capex which is increasing, which is inherently making the return ratios, which at the time of IPO was close to 40%, now we are under 20%.
Sanjay, you could see our ROCs have been constant at about between 20 and 23%. That's what the ROCs have been. And I think once these new capexes come on stream, probably 2 years down the line when they get their substantial capacity utilizations coming forth, I think the ROCs will again peak. They will come back to the 23-24%. We are already at 22%, so it's not that our ROCs have declined in any way.
And Sanjay, to add here, our ROIC, which you would also be measuring, ROIC has increased quarter on quarter to substantial level. So ROC at 23% has not declined at all. ROIC has increased, and Ketan sir will share with you separately the ROC to the first.
Fine. One last question from my side on the capex. There has been a 75 crores of capex in the first half. Can we help us understand where have we spent this 75 crores? And what should be a capex assumption for this year as a whole, now that we are embarked on the capacity expansion in both Unitop and Dahej?
So the capex has been divided into 4 different companies. So totally you see consolidated figure of 25 crores, which is as per the approval from our in the budget in the annual results budget annual results board meeting. This is on different areas. So it has been on ETP expansion. It is on the NMO project. There has been solar installation at the tank farms have been involved. There is debottlenecking, at different areas. There would be maintenance capex. And then we have some, purchase of some brands, and then also the GIDC effluent line. We have a toilet line. We have taken some packaging machines at Silvassa. So this has been spread over 4 or 5 different sites I think we have approval now from total 58 crores for Rossari and about 158 crores 120 crores in Unitop, which we expect to complete in the next 18 months. This is going to be ongoing as we had a very, very good quarter last quarter, and we see things to be good.
So what is the capex are we planning for this year and next year?
This year we will be out of that 170 total crores of 178 crores of capex that we announced. We will spend I think roughly about another 50 odd crores in this year.
So basically 70, 75 plus 50. So this year we will end with 125.
Yeah, around 125, 130. That's the plan.
Okay. And next year we will be doing a similar amount of capex.
Yes, the balance will go in the next year.
Fair enough. Just last one on the ethoxylate. It is largely to support the growth in the Unitop, or we are looking at expansion of the product even in the HPPC category for the cleaning segment?
So ethoxylate is growing into we are at 100% capacity utilization in Unitop. So the existing markets, in July and August we had nearly 40 days of waiting for orders. So we lost some orders in fact in July and August in Unitop and Tristar. So we do not want to have the same situation that customers are happy. So existing, all the segments are doing well, and it is for extra production of the existing segments.
And it will come next to the same existing plant. And do we have tie-up for EO for this expanded ethoxylate? I think last year we had a problem with EO availability.
Reliance has adequate capacity, so we do not foresee any issues on that.
Got it. That's it from my side. Thank you, sir. Thank you for answering all my questions, and best of luck for the company.
Thank you.
Thank you very much. Next question is from the line of Rohit Nagaraj from Centrum Broking Limited. Please go ahead.
Yeah, thanks for the opportunity and congrats on a QOQ improved performance. So first question is in terms of the capacities peaking out in Unitop and Tristar. So I understand based on the capex plan, probably new capacities will be coming 1 year hence. So how do we foresee growth in these two subsidiaries over the next 1 year? Thank you.
So, Rohit, so these capex as we have announced will come up in a phased manner. So some of the phases will start coming up over the next 6 months. And then the Q4 or whatever we said, the Q3 of FY25 is when the entire project will get capitalized. So I think the plan is that slowly we will start putting up the ethoxylation capacities at Unitop in a phased manner. And then by the end of the Q4, the entire thing will come through.
Sure. And the second question, in terms of the availability of further expansion, after the capacities are put up in Unitop, do we have further scope for expansion? And just one clarification, so the 70 crores capex in first half excludes the 50 plus 128 crores of additional capex. Is that right assumption?
Yes, that's right. And and then on the first question about availability of, you were talking about in terms of availability of space?
Right.
I think we still have some space available because our the major capex is coming up at the Unitop facility of Dahej. The capex at Rossari Dahej facility is a smaller one, so we'll have space for expansion.
So to add here, Rohitji, we have 19 acres land in the Unitop site, and we have space for expansion there. We are also trying to acquire the neighboring land, but we are not so successful. So the 128 crores also includes, some land approvals, land which we have planned and may happen or not happen. But at the moment, whatever we have planned, we have adequate space for the expansion in both Unitop and the Rossari.
Sure. And just one last clarification. On the raw material side, so how has the import and domestic mix changed over the last 1 year? And incrementally, how do we foresee, given that probably we'll be further scouting for domestic supplies? Thank you.
So if you see, acrylic acid is now practically mostly domestic, which comes from the BPCL plant. Acetic acid is something which we continue to balance between GNFC and imports. Other than that, we have a lot of raw materials now which are in Unitop, which is products which are imports. But if you see our exports to imports, our exports are nearly 1.5 times of imports. So the forex is, we have a natural hedge on forex fluctuations.
Sure, sir. Thanks for answering all the questions and best of luck.
Thank you, Rohitji. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Yeah, hi. Good evening, sir. So my question is on the asset turns. So earlier today in the interview highlighted that the new capex of 180 crores should contribute roughly 400 crores in top line. However, historically, Rossari has done at least 3x of gross asset turns. So would you like to comment anything? Would the sales potential be higher than 400 crores here?
Yeah, so Aditya, the potential for these projects is definitely going to be far higher. The 400 crore number which we talked about would be the number probably in the first 1.5 years is where we would reach. I think at a peak revenue, we would be closer to 4.5 kind of an asset turn. We should probably come, around the fourth year, around the four year, yeah. Around the 4 year mark, we should be there.
Fair. And on the capex of rupees 75 crores in H1, what was that spent on?
So I think Rossari just said, so that was spent across all our group companies. So they were spent on, the effluent treatment expansion. In fact, that was done in all the 3 plants of ours, in Tristar, Unitop and Rossari. There were some more spends on the NMMO old project, which we had talked about in the last quarter. So that was a smaller project, and then we further expanded that. Some spending on various warehousing facilities we put up. We put up a solar facility, and there were some other GIDC requirements, some tank farms. With these requirements of EO going up at both Tristar and Unitop, we have to put in additional tank farms, and these EO tanks are quite a big tank in terms of the spend. So apart from this, there were other small maintenance capexes and some, in BRPL we bought in some IPs across various products. So all this was a spread of about 70-75 crores in the 6 months.
Got it. My last question is on the gross margin. So of course AHN was lower. Textile has still not made a comeback, and we have sort of focused on volume over margins. So is it a right inference that this should be the bottom margins in terms of gross margins, and the only direction is up as AHN makes a comeback and textile cycle also comes back? Would you have an outlook on how you are looking at gross margins overall? And in other expenses, if you can sort of break us down what was so the delta which I see from Q1 to Q2 is roughly 10 crores more. So if you can help us understand what the exhibition expenses, etc. were, and where do you sort of see a broad run rate? I mean, if you want to qualify some of these as one-offs, if that would sort of correct to by some number, if you want to put some comments there. Thanks.
So I think on the EBITDA, I already talked about it. I think the current levels are where around that level we should be by the end of the year. We, as I said, our emphasis has been from the start of this year to fill up capacities, increase our volume of takes, and that we've seen in the first half. We'll continue with that strategy going forward. So even if it's a little bit of cost of the margins, we will keep leveraging our facilities and the capacities that we have. So we should. I think it will be better if we should be around the same kind of margin number in the second half. And on the other expenses of 10 crores, I would not say there is any major one-time kind of an expense. These are expenses in line with the growing size of the business. If you want to take I think the half-yearly number, if you see, is at about 88 crores. I think that run rate would be a better run rate to stick to.
Fair. That's it from my end. Thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Next follow-up question is from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
So just wanted to know your view. You mentioned that it will be funded by both internal accruals and debt on the future capex. So how are you looking at the debt levels for FY24? If you have any number worked out, as there is some cash stuck in working capital too.
So I think the working capital, as I said in my opening commentary itself, the 98 days is slightly on the higher side, more to do with the seasonality of the business. I think this should even out a little more. But the way the business is growing and the size and the customers, I think the working capital would be between 85 to 90 days going forward. I think that's what our targeted working capital days would be. And on the capex front, I think we will, as I said, these capexes are going to happen over the next year, 12 to 18 months. So we'll have enough time on the spread of the cash flows. We will go in for some debt depending on what our cash reserves are and our cash levels are. Nothing has been worked out as of now, but I think the way we are structured in terms of debt to equity, we are very, very comfortable. And even if we borrow the entire amount, I think we'll be quite comfortable in terms of our paying ability and the overall balance sheet strength.
Got it. And my last question is on the animal health segment. There was an element of seasonality, but nothing very a major concern there, right? It should sort of make a comeback in the H2. Is that the right inference?
No, there's nothing. We were, cautious on total outstandings in the market, and as I said in the team call, there was a double Shravan, and we are mostly into poultry industry. We continue to hold that the AHN industry is something which we will focus upon and should do well in the future.
Great. Thanks. That's it from my end.
Thank you, Aditya.
And all the best for your future. Thanks.
Thank you. Next question is from the line of Ashish from InvesQ Investment Advisors. Please go ahead.
Yeah, hi, thank you. Sir, I wanted to know your thoughts on textile chemicals segment of ours. How are you reading the coming 6-8 months for the business, both in terms of top line and margin?
So I'm Edward here. So the textile chemical business, we had seen headwinds in the last 2 quarters. Now we've taken a lot of steps from our side to focus on certain markets, and especially the Bangladesh market. Where we have strengthened our team with 2 very senior leaders, and also Rossari Bangladesh is also incorporated now. So we believe that there will be an uptick in the Bangladesh business for us if the forex problems, etc., get solved. So in the coming year, we see pretty good demand from this area. Apart from that, we've also had some reshuffling within the organization itself, and now we have a new leader for textile within the organization, and I think this has inducted fresh energy into textiles. So the focus will be domestic market and the Bangladesh market, and we're also looking at other markets like Turkey and Egypt, but with the new geopolitical issue, I do not know how that will pan out. But we've gained market in the textile area, and we've become stronger. So we're very positive for textile business in the next year, coming from January 1 to 2024.
So would you say that, what we are hearing from most of the textile players, that the inventory issues would take a kind of a pause there, and inventory refilling might happen in the demand markets, developed markets, and that's what could get the demand on track maybe a quarter to go for that. So would you concur with that view that things might look up maybe 3-4 months after?
So, are you asking us about, I'm Chari here, Sunil Chari, are you asking us about the inventory levels at our customers' end, at the textile customers' end?
No. What I'm asking is, since your customers will be supplying to developed markets probably, right? And the inventory destocking that happened over the last 3-4 quarters in US and Europe, that probably a certain level of correction has already happened, and again it will come back to normalcy maybe 3-4 months down the line. That's what we are hearing, second half sometime. So concurrently, the chain, which is your customers in Bangladesh, etc., and again your business would be taking some upturn. Is that reading correct? Maybe in the second half sometime. Should that happen?
Yeah, actually, when we talk to our customers and they tell us, the discretionary spending of U.S. consumer on textiles has not increased in the past few months, and they are not still sure of the future. It is because higher interest rates have translated into higher EMIs, and the amount of income they have left for spending on textiles and other things has decreased. Plus there was subsidy during the COVID from the US government, where per month, every month there was some money coming. So things are still not clear on what will pan out in the future. But we hope the domestic demand is picking up, and for textiles now, if you see what was Bangladesh, we are at least at 1/3 because we choose to be say then sorry later. We did not supply to anyone on open terms in Bangladesh, and even in countries like Egypt and Mexico and Argentina, and even Turkey. These were our big markets. All these areas we face, our customers face currency, and they asked us to supply on open terms. We said no. We are prepared to forgo business rather than risk our capital. We do not have bad debts in our systems for the past 26 years, and we do not want in the future also. So the Bangladesh business is now nearly 1/3 of what it was last year, and we are happy. We are happy not to do that business till we have safety on the money. If the Bangladesh business picks up and the local demand, we think should do well in the future, we will do better in textiles.
Okay. Thank you so much.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Vishal Biria from Bandhan Mutual Fund. Please go ahead.
Hi, good evening. Audible?
If you can speak a little louder, please.
Yeah. So my question was on the agro surfactant.
Sir, sorry to interrupt you. You're sounding very distant. May I request you to speak through the handset?
My question was on the agro surfactant. How demand? First quarter was very good for this. So how was it for second quarter, September quarter, and how's the outlook? And so that was one. The second was on the pricing front. Have the prices more or less stabilized?
Good evening, Vishalji. The prices have stabilized normally in ethoxylates. EO is a key raw material, as you know, for agro surfactants. In this season, we have at least 10-12 days of very low ethoxylate because the supply from Nagasaki plant is shut down, and then we do not have enough EO available in those seasons and in the second quarter. The agro season has not been good for agrochemical customers, the ones who make the agro formulations. It has been not so good, which you would know from talks with all the agrochemical companies. But we have done very well, sustain the demand in the agro surfactants, and we are looking at growth in the export markets also for agro surfactants.
Vishal, do you have any follow-up question? Vishal, can you hear us?
Thank you. I'm through with my questions. Thank you.
Thank you, Vishal.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Siddharth Purohit from InvesQ Investment Advisors. Please go ahead.
Yeah. Hi, sir. So just wanted to understand what was this capex for? Couldn't understand properly. Will it result in direct incremental revenue, or it is some backward integration, you said?
You're talking about the capex which we have announced?
The Dahej one. You mentioned 50 crores and 150 crores incremental at Dahej. Is it regarding?
Yeah, so those are all capacity expansion projects. The one at Unitop is for the ethoxylation and related products, and the one at RBL is for products which will go into the HPPC division of ours.
So to add to here, it will be adding, on an incremental sale of about 600 crores if we reach the peak capacity in the next 2, 3, 4 years.
Okay. Now, the reason I was saying that, probably in the previous call you had mentioned we are still at a lower utilization level. So is it some new product, or how is it? That's what I was trying to understand.
If you see the large project at Unitop, the ethoxylation capacities are all almost peaked. So in fact, in the last quarter we were at 90% capacity utilization. So as a future plan of action, that capex has been has been put forth, and this will happen over the next 12 to 18 months in a phased manner. So overall then the capacity availability will, on the ethoxylation front, will go up by about 30,000 metric tons.
So Siddharth, to add here, when we came for IPO, we were 600 crores and we had promised four double growth in 4 years. This quarter we were 332 crores, and this translates already to nearly double the revenue we have crossed within 3 years. We were at a very healthy 78% utilization at Dahej, and the tractor and unit up we were practically 100%. And the capexes we used in the past 6 months, for example, in TriStar, we changed and automated a lot of flow meters to increase production without adding to big capacities. But also we had to put in a lot of new tanks in unit up just for storage of raw materials and finished goods after we do evacuation. We did some debottlenecking. If you see in the Rossari business, we have probably close to 5,000 products, and you cannot have 100% capacity in a multi-product manufacturing facility because there's changeover, there's washing, there are small batches. So 80% capacity at Dahej, and ethoxylation time also we have been able to ethoxylation at Russia and Europe we've been able to get nearly 100%. Our teams worked extremely hard to cater to demand which we had. Vishalji of Bandhan asked us a question. We lost some orders because we did not have adequate capacity to service those orders. Otherwise, our quarter would have been more stronger.
Thank you. So the line for the participant dropped. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1. I now hand the conference over to the management for closing comments.
So thanks to all of you for giving your valuable time. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CBI India. Thank you once again for taking the time to join us on this call, and good day.
Thank you very much. On behalf of Rossari Biotech Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.